look at Tony Robbins. You know Tony Robbins, right?
Yep.
He has over 100 businesses, 100. But I can assure you, to get to that level, he focused on one business. And then he started diversifying.
In this episode, I talk with Chris Salerno. Chris is a former top real estate team leader who has personally transacted more than $40 million in real estate volume and helped lead the #1 team in the Carolinas to produce over $140 million in annual sales. He's now a multifamily investor that has transacted over 1,400 units. We discuss how he went from a solo real estate agent to a multifamily investor, his advice to other realtors who want to invest in real estate, his first multifamily deal, and the real estate market. I hope you enjoy. Now onto the show. How's it going, Chris?
Phenomenal. How are you doing, Chris?
Good. You got started investing in real estate in a little bit of an, I'd say, unique way. And it's definitely a way that I feel a lot of folks should. And that is, you started off as a real estate agent, right?
Yeah, that's right. Yeah. I've been in the real estate industry for about 9.5 years, but I started off as a residential real estate agent here in Charlotte, North Carolina.
Yeah. So a lot of real estate agents, and I preach this a lot, and really, I didn't know because I started off the complete opposite way. I was a real estate investor first. And then later on, got my license. I wish I got it sooner. But in any case, kind of a mentor of mine was like, "Hey, look, if you're going to be a professional, and you're going to be in this long term, make it official. Get your license
too. Mine as well."
Yeah. So I ended up getting my license. I'm like, man, I should have got that sooner. And there's a lot of noise out there saying, "Oh no, don't do it." And it's definitely not a prerequisite to success, but it can definitely be a valuable asset to your business. But you got started as a real estate agent, a solo agent first, and then moved on to a team leader, right?
Yeah. So I'll give you the full background. So 9.5 years ago, got into the residential real estate game. And in my first year and a half, I did 40 million in annual sales. I did that with doing over 75 open houses. I mastered the art of cold calling.
And that's as an individual agent, right?
Individual agent.
Yeah. That's phenomenal.
Towards the end of that year, thanks. Towards the end of that year, I started starting to build my own team. Now, keep in mind, at that time, the median income home price for Charlotte was like 275. So we're not talking Miami, we're not talking New York, LA.
Yeah, where it's a lot of volume. A lot of volume to hit those numbers.
Correct. It's cranking it out. And so, and I'll tell you guys actually one thing that I've never told anybody here coming up on, I've never told anyone this on any podcast episode, but I'll tell your listeners something that really opened my eyes coming up here soon. But I started building that team towards the end of that year and a half. When I did that, I was approached by the #1 team in the Carolinas. And at the time when I joined, or when I was bringing them up to where they were at, we ended up being 4th in the world with Keller Williams. And there was approached to them by merging our businesses. We came to terms, merged our businesses, and then I fell into their operational roles, their COO. I ended up coaching everyone that came on. They had to go through my coaching program to get them up and running. I had an 18-year-old student who sold over 76 houses his first year, and he now has his own team that he runs with EXP here in Charlotte. We still stay in touch because he was actually the one who, on top of paying quarterly taxes, and I needed a tax deduction, not knowing if I was a real estate professional, I could utilize 100% of these tax deductions that large multifamily real estate assets provide. He was actually a huge part in my transitioning to leaving everything, selling it all, letting all my licensing go, to then creating QC Capital towards the end of 2018 and beginning of 2019. And then growing QC to what it is today, upwards of 250 million AUM, over 1,000 or really over 1,200 units in our portfolio just within 4 years.
Well, was that the catalyst? The real estate professional, the tax benefits, just realizing that like, hey, you're crushing it, but you're paying so much in taxes, and you realize like, hey, there's this other world over there where you can crush it over there too, and take more home. Was that the 100%. Catalyst for the transition?
It was a big part of it. I got a tax bill saying you're late and now you owe fees. And I'm like, what do you mean? Like, my CPA, covers all that. So I called my CPA up. I'm like, what is this document? She says, Well, you're now in a new tax bracket, and now you have to pay quarterly taxes or you get penalized. I said, are you serious? I said, this is ridiculous. And so instead of going out and buying cars and depreciating assets, I wanted to buy appreciating assets that are going to give me tax benefits and build my wealth.
And what sparked? So that is it's phenomenal revelation. So you got to that point mentally, but what sparked that? Because most agents are completely oblivious to that.
Yeah, no, I agree. What sparked that is one, I didn't want to pay those quarterly checks to Uncle Sam. But
So it
what
was
sparked it is,
how can I get out of this, or how can I avoid this?
yeah, how can I get out of this? But I've always wanted to grow a big company. I mean, I took the team from 92 million in annual sales to 147 million just within another year and a half. And I'd let all of that go because I saw the bigger picture of private equity. If you look at all these billionaires, they're hedge funds, they're private equities, companies, and they're buying all these larger real estate, buying all these opportunities that your average Joe who's just driving on the street or your average individual who's making 500 to a million a year may not have the ability to have access to. And so that is another reason why I wanted to create QC Capital, to then give that ability and that access to all of the investors, even if it's, using your 401k to invest in these deals. We have a client or an investor who just emailed me saying, I want to transfer you everything in my 401k because you're offering a 4% annual interest on investors' money while we wait for you guys to find a deal. And I'm like, well, let's talk. Slow your roll there. So offering these type of opportunities to investors and now, to real estate agents to use the tax benefits that this offers and also build their wealth as they're building their company and helping other people buy real estate is our main passion here.
Yeah, so I talk a lot about pattern interrupt. So you're crushing it as a production agent and now part of it, one of the top teams in your market. Everything's going well. Then you have this pattern interrupt of this tax bill, and you're like, hey, let's this is a problem. But your end goal was always to build something great. And
Correct.
so at that point, now you're like, hey, how can I build something great? Maybe it's not continuing what I'm doing now. Maybe it's doing something else. So you're looking at this investing. Was it immediately over into multifamily, or did you just be like, hey, I need to buy some single family properties or go
Nope,
wholesale
nope.
some houses?
So I had single family, I had fix and flips. Me personally, yes, you can make money. My girlfriend flipped homes, but I've opened her eyes to multifamily. I had those single family rentals. It doesn't make sense. It does not make sense on single family rentals. You have one tenant, one person paying the rent. If something happens, you have to come out of your pocket. If anything happens large, HVAC, roof, you name it, that right there can wipe out your whole profits. And so I let all my single family portfolio go. I sold everything I had. And I'm a firm believer of the book, The One Thing, wrote by Gary Keller. I believe he's still the CEO of Keller Williams.
Great book.
But the phenomenal book. It tells you to focus on your one thing. And now some people may say, well, Chris, sometimes you contradict yourself because you say diversify. There's two different things. In my opinion, you have to focus on that one thing if you're a business owner, which is your business, until you grow it to a certain level. And then you can seek diversification with other investments. I've grown QC Capital to a certain level. Well, now I have experts in the early stage startup companies where I can invest passively and focus still on my one thing, but I can still diversify, which is super important. So I am a firm believer of diversification up until a certain point. But to get to that certain point, you need to focus on one thing.
Yeah, there's this there's the phrase, I'm sure you've heard it many times, like most millionaires have like 7 sources of income, and the whole thought behind that is, or at least the message behind that is hey, you need to go out and get 7 streams of income, when that's not really how it is. Like, those millionaires made their money on 1 or 2 streams, and then they went out and added others later on.
I mean, look at Tony Robbins. You know Tony Robbins, right?
Yep.
He has over 100 businesses. 100. But I can assure you, to get to that level, he focused on one business. And then he started diversifying
100%.
into resorts, into multiple coaching programs, you name it.
So why do you think more real estate agents don't do, or I'll say this, in talking with agents over the years, most say, hey, I want to invest in real estate, but they don't. Why do you think that is?
They don't have enough knowledge. Even though they are real estate agents, they
They're
help people.
insiders.
Correct. They help people during a transaction on buying and selling. They don't have enough knowledge to buy an apartment complex. And I say that very nicely. Buy an apartment complex, analyze a T12, a P&L, which is also the T12. Some people don't know what a T12 is, or the rent roll, and to understand, well, there's a high loss to lease. How can we clean up that loss to lease? What's going on with the vacancy here? When you analyze a rent roll, what are the efficient rents? What are the gross rents? All of that plays into a factor, which they don't know at the end of the day. And they may be phenomenal sales agents. They may have a team, which I've hung out with the top teams, top 25 with Keller Williams. When I was at Keller Williams, Gary Keller's top 25 in the world, top individuals in there. And they are laser focused on growing their business, that one thing, which is great. But diversifying, actually, think of this as a real estate agent. If you diversify and invest with both Chris's, invest into real estate, and you utilize those tax benefits because you're already a real estate professional, and so it wipes out your taxes. What can you do with that extra money to grow your business?
Yeah,
To then invest more.
Yeah, most realtors don't know that they're sitting on one of the greatest tax benefits that the IRS allows.
And
But they have no idea
IRS,
what real estate professional means.
Agreed. And the IRS is not going to write you in an email or send you a letter with bold 50 font saying, hey, there is a tax exemption option for real estate professionals. If you buy real estate, do a cost seg depreciation on it, you can depreciate the asset and utilize that as a depreciation off your taxes.
Correct.
They're not going to put that in. It's
No.
going to be in the little fine print where we're going to have to zoom in 250%. So it's advantageous to help you to grow your business by investing into real estate and then using that excess cash to grow your business. On top of that, you can also give another type of service to your high net worth individuals who are buying expensive homes that they can also invest into real estate.
Yep.
So
it goes back to what you're saying, education. It's all
100%,
education.
100%.
So what advice do you have for agents that they would like to make that transition? And well, let's be clear here. A lot of agents, especially the successful ones, they love what they do. They may not want to do it forever, but they love what they do now. They don't really want to be a full-time. They don't want to do what you do. They don't want to do what I do. They want to still be an agent, run their team or whatever, but they would like to invest part-time. And then there may be others that, I don't know, maybe they're a little tired of it and they want something new and they would like to go full-time as an investor. But what's your advice to agents that want to make that transition over into the investing side?
Start educating yourself. If you go to qccapitalgroup.com, we have a free book. I hand sign a free book. We mail it out to you. It's free. You don't have to pay for shipping, nothing. And it comes in the mail. You can read through that. It takes less than an hour and it helps educate you on the next steps of multifamily investing and getting started, what questions to ask, what to look for, the ins and outs. Start with education. Just like if you were becoming a real estate agent, what did you start with? You start with education. You had to take the state test. You had to take the national test. And you have to study to answer those questions. And then once you answer those questions and you sign up with the brokerage, what do? They put you through a training program. Just like you went through that, you have to do that when it comes to investing your own personal finances.
Love it. Love it. So in multifamily, how'd you get your first deal? What did that look like?
Excuse me. First deal, the best thing I can say is that utilizing my ability as a broker or previous broker at that time really connected with the commercial brokers. I was fortunate to really get close with the commercial brokers in the Carolinas, and I started networking with them, building relationships. It's all about relationships in this business of building of the commercial brokers. once I started building those relationships, I was able to then secure the first deal. And from there, it kind of snowballed.
So, and that's very important because relationship is very key in real estate, especially, or actually on both sides of the aisle, on production and investing. From a multi-family standpoint, it's very much a team sport. So,
Yes.
was this a deal that you went in and you were lead, or you partnered with another operator to take down? How many units was it? What did that look like?
Yeah, so the first ever deal was actually here in Charlotte, North Carolina, here in our backyard. And that was a partnership. We were lead on it. That was a partnership. It was a 44 units. We bought it for 4.4 million. And definitely very difficult for the first deal to raise capital. From there, once we acquired that, we then partnered and learned and really progressed and perfected the art of raising capital. And then from there, we raised capital for a couple of groups, and then we started just solely focusing on our own deals. That's all we focus on right now, is acquiring our own assets or JV opportunities.
Yeah, I think that's really important. I made the mistake on my first multifamily. It was a 29 unit, and I've told this story before, that I was going in lone gunman. Now, I bought it at such a ridiculous price that I knew I could afford to make mistakes and still make money. Fortunately, I made a lot of mistakes and still made money. But had I partnered, I would have made a lot more. I mean, we bought this thing for, this sounds insane today. It was like $17,000 a door. It was in pretty rough shape. But yeah, by partnering, not only are you leveraging their success, their Rolodex, their experience, their balance sheet, it helps fast track your education. Maybe you make a little less, but quite honestly, you probably actually make more, because half of a lot is much better than zero of not or 100% of nothing. But really, they're going to be able to help fast track your success, not only on that deal, but on subsequent deals, right?
Yes, very much so. Very, very much so. It's a team effort. It's a team sport. We all have to work together to acquire these type of assets. It's very difficult to just do it on your own unless you're a billionaire and you have the cap. You can just do it on your own.
So, how many units have you closed over the years?
We have closed over the years over 1,500.
Okay,
And that's
so
all
yeah,
sold.
okay, so quite a bit of units. And when on your, are you still partnering and collaborating with other operators?
We're only doing JV opportunities or doing our own deals, and that's with partnering as well, co-sponsors and things like that.
Yeah, because that's another thing that I noticed. So I mean, with single family, it's very easy just to be a lone gunman. Most single family investors are like, there's not a lot of need to partner,
Agreed.
except for maybe your first deal or whatever. But in multifamily, especially large multifamily, it's a completely different game. You
Oh,
typically
it is.
see 1 to 3 operating partners, which with their own teams, all performing various different aspects, whether it's the asset management, property management, construction management, acquisitions, finance, KP. There's just a lot of very crucial jobs that you screw up one of those, and it can really, really mess up a deal for everyone.
Oh, it can. Most definitely. It can mess up everything.
What are your thoughts on the current state of the market?
Ooh, it's a fun environment. I think it's definitely separated the big boys from the little boys in this current market environment. I think Feds are going to raise interest rates a little more, and then they're going to taper down. We got a very large presidential election coming up in about a year and a half. So, politics do have something to play with in the market. And so I think they're going to watch that very closely. People are still spending a lot of money, so it's a very interesting times. The more they raise interest rates, I think the more it benefits for multifamily, because people need a place to live. It's a necessity. It's not going anywhere at all. And it's a business that I truly love. And I'm actually in the process of starting another business, and that business is a necessity. And I was thinking, I love businesses that are necessities, no matter the type of the downturn you're in. If it's a necessity, people need it for their health, for to live, it's always going to be around.
Yeah, and, food, shelter, shelter being real estate, that it's not going away anytime soon.
It is not. No, very much so. We all need water. We need shelter. And it's very important to make sure that we can, utilize that and live with it. And we're going to have to because we need it.
Yeah, and there's definitely something to say, something to be said for interest rates. They've gone up so high over the last 18, 24 months. It shocked a lot of investors that didn't do proper due diligence. But beyond that, it's created another problem for affordable housing, which is going to force a lot of homeowners to stay put. Some of those, actually, quite a lot of homeowners are staying put just because they're not letting go of their 3% mortgage.
They
So
are.
there's that. A lot of those folks may never ever sell their house.
They may
Then
not. It depends.
it all depends. But it's they're going to be a lot more reluctant to sell their house. Then there's first time home buyers, which, I mean, if they were pricing mortgages 2 years ago and they're pricing it now, like it's a problem for them. And then you got the price of homes. Something's got to give. They got to make more money, or they got to really start adjusting their expectations on the quality of home, which plays into multifamily. So if they're not buying, then they're going to be staying somewhere. That's either because they own a home, they're just not moving, or they're going to continue leasing. So that's the stimulus, and really the only way I personally, and let me know your thoughts, I see out of that rut, other than interest rates falling, is new construction, which has been, from a single family standpoint, very slow nationally, like
I will
submarkets.
tell you, here in Charlotte, single family companies like D.R. Horton, that are very large companies, are building these single family homes and townhomes here in Charlotte with aluminum instead of lumber, because of the price of lumber, I guess, is more expensive than aluminum.
Wow. Like aluminum beams or something?
Yeah, yep, all aluminum beams and
Interesting.
everything.
Kind of like the
Like
retail
an
strip
office.
centers, and
Yeah,
yeah.
like a retail and office space, they're using that now. Because according to the rep here in Charlotte, it's a lot cheaper than lumber right now at the moment, which is
Interesting.
shocking.
Can you imagine trying to hang a picture? Instead of the stud, you hit the aluminum beam.
I know. You need a metal detector or something, to try to find it.
Huh. Hey, that could be a new hot product. So instead of those, what do they call them? The magic hook things you put on the wall. You just have one that's like a super magnet or something.
There you go. You can put magnets now. That'd be neat.
Yeah.
But yeah, times are changing. Things are different. I think also, the price of labor is astronomically high.
Mm-hmm.
So,
Yeah.
it's different.
So that's one side, but the other side of the high interest rates is it very much impacts valuations of all housing. Single family is a little different, because it has actual owner occupant utility. Multifamilies doesn't. It's a business. It's purely a leasing business. So investors buying in are buying on yield, and higher the debt costs, it impacts their yield. So it definitely impacts valuation, which over the past 12, 18 months, that bid ask prices, it's been wide. I don't know that it's really narrowing, maybe a little bit. How do you see that shaking out, at least over the next, say, like 12 months or so? You think we're going to still see a wide gap, or is it going to start closing up?
Being an agent, and I'm sure everyone can relate to this. If you're a true listing agent, you know that when you go into a listing appointment and you talk to a seller, and the seller thinks their home's worth 600, but you got to break the news to them and say, hey, the market, your neighborhood, here are the comps, here are what your other properties, have going for them. It's at 525. And, you're going to get those sellers, no, you're ridiculous, get out of my house, blah, 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 blah. I'm listing with that agent who told me 600. Then it sits on the market for 90 days. Then they come back to you and say, why is this not selling? And you said, well, Mr. Seller, I told you it's not selling because there's a huge price gap. And they may say, well, you're still wrong. I've had that happen all the time. I've had some come back and say, we want to list with you. And I'm like, well, that 525 is no longer 525, it's 480.
Yeah.
That's just the market. And, I'm a messenger. I'm telling you what buyers are doing right now. That is happening in the multifamily space. We are trying to buy assets and there's a far gap still. Sellers don't want to sell. However, up until 2025, there's about 1.7 trillion, I believe a little more, or excuse me, 1.25 trillion, because I looked it up the other day, of deals or of loans that are come due. And so you're going to have to sell. You probably can't refinance. If you do, you're going to have to bring more money down to refinance, but you're going to have to sell. So what happens in that scenario? What do you do in that scenario? You're going to have to either talk to your investors and say, hey, you're going to take a little loss, or hey, we can break even, or you may be able to profit a little money off of it.
Yeah.
But that is going to be opportunity if you can stay strong during this market cycle. You have to stay strong. You have to underwrite correctly when it comes to these deals.
Yeah, the debt is one thing that keeps commercial real estate moving, because 30-year fixed, very common in single family, not quite as common in commercial finance. They're typically fixed for a period of time, shorter period, 2, 3, 4, 5, 7 years, or whatever, 10 years. And then after that, they're floating. If they're not floating day one. But even if they are floating, there's rate caps and those expire and you got to buy new ones, and they're astronomical now. So it's a lot more complex with commercial, but that can force a hand. And I think there's a record amount of bridge loans this year that are coming due. And a lot of those folks, if you bought it over the past couple of years, you're probably not in the best position to refi to meet, debt coverage ratios that agency debt will require.
Agreed. It's all different. And the lovely part about commercial debt is you can negotiate. I mean, you have fixed, you have a floating rate. You also have some buy down options of the rate, which we're doing right now at the moment. So there's so many multiple options that you have. You just have to know how to negotiate.
So, last question, we'll kind of close it out. Do you see, I'm seeing both sides of this. So in Houston, you probably heard about it. There's a large portfolio that was foreclosed on. They had floating rate debt, didn't purchase rate caps, coupled with bad management. It was a bad situation for a
I know about it. Yeah.
fairly inexperienced operator. Unfortunate, but do you foresee a lot more of those? Because there's those that are saying, hey, this is the tip of the iceberg. There's a lot more of that stuff coming. They're like thinking 2008 again.
100%. I mean, I'm seeing it. I'm seeing it right now. I'm seeing groups are doing capital calls, raising additional equity, because they have their rate caps up. We just bought an extension on our rate cap to be safe till 2025. And we did that to make sure that our property is well positioned. And so it's very important to have options. Some of these groups are raising, I've heard, 4 to 5 million just to pay off that difference, and investors are still not getting distribution. So that is not our group or our deals, but that is what I'm hearing in the space when it comes to some of these other deals, because they were buying $100 million property and getting 90% leverage and only bringing $10 million to close it. And now they're realizing, well, those good old days are not really here.
and I mean, I look at it from a different angle. I'm looking at it from the capital angle, and really, bridge debt was almost the only way you could get deals over the last couple of years.
So it makes sense. It was.
Yeah, it was just ridiculous. But I was looking at it from a standpoint of, hey, this is cool right now, but like when the music stuff, like this is a really, really dangerous game to play. Because it's clearly
Warren Buffett has a famous saying of, when the tide goes out, you'll see who does not have pants on.
Yeah. So it's like, I mean, I think everyone knew there's no way that we're gonna have astronomical rent and price growth in perpetuity. It's clearly not going to happen. Yet still making aggressive decisions. I don't know. I don't want to say that most of them. I'm sure most of them are doing it very prudently from their standpoint. But there's also a lot of syndicators out there that they work off fees. Like that's how they make their money, because waiting for 5 years to get paid I mean, you gotta pay for your team now. But how are you approaching underwriting now to, and this is kind of the last question before we close out. How are you approaching underwriting to make sure your LPs are and the total project is in the best position to win
Yeah,
in this market?
we're really not going over 65% leverage. We're buying great quality assets. Starbucks has me suckered, and I'll tell you, it even has my 3.5-year-old son suckered more than me, because my son will get in the car, we'll pass a Starbucks, and he says, "Egg bites, Dada." And I'm like, oh, here we go. And so they have one, I had it this morning too, so it's really good. And the reason why I say Starbucks is a publicly owned company. It's traded on the stock exchange. However, it is corporately owned, which means it is not franchised like Dunkin' Donuts or McDonald's. So before a Starbucks goes into a location, they do a tremendous amount of research on demographics. Have you ever seen a Starbucks in a Walmart? No offense to anyone that shops at Walmart, but you're not. You see a Starbucks in Target. Why? Target is a higher priced product than Walmart is. We like to look, where's Whole Foods? Where's Fresh Market? Where's Target, Starbucks, and where's Chick-fil-A? So we're buying in great quality locations that have higher median incomes, where those tenants can absorb any type of market correction. And so that's what we really like to target. Piggybacking on the debt, we make sure that we're buying great quality debt, a little lower leverage where we're having to bring a little more money down, but the debt is gives us options to sell, to refinance in the future if needed.
Love it, love it. And one quick final thought, because you were talking about, you're having to bring more equity to the table, raise more capital. Have how have LPs adjusted to that? So when you're bringing more money, that does impact yield. It impacts their returns, depending on the asset. So
Yep.
are they becoming? Was there a little bit of sticker shock at first? Because there's definitely a lot of LPs that will throw the money at an IRR. Dangerous, shouldn't do that, because it's all risk adjusted returns. But how have your LPs been?
IRR, it's like when an investor says, "What's my IRR?" I said, "What do you want?" If you
Yeah,
want 25%, I can hit a couple numbers and get it for you.
yeah.
It's so misconstrued, and I try to preach that so much. IRR can be so misconstrued because it takes into consideration time.
Mm-hmm. Yep.
But
Yep.
to really watch that question, or to answer it, the market has changed. Leverage one has came down, but the purchase price has also came down in certain markets. And so with the purchase price coming down and the leverage, the quality of the deal will increase the net operating income. So you're actually seeing more cash flow on these assets now
Yeah.
than you did back then. Back then, you'd see a 3 to 4% average cash flow. Now we're seeing 6 to 8% because the purchase price is coming down, and it has to in the current market environments.
Yeah. Love it. All right. The last 4 questions I asked everyone. First one
Let's do it.
is, if you could give your advice to your 20-year-old self, what would that be?
If I could get advice to my 20-year-old self, and my 20-year-old self wanted to create a private equity company like I did, I would say become an unstoppable capital raising machine. Learn how to raise capital, find a mentor as soon as possible, and learn how to raise capital.
What book or books have greatly influenced your life?
Oh, that is a good one. I would say there's a handful here. I would say Traction is a great book. The Code of Extraordinary Mind is another good book I truly love. Primal Branding, and then Think and Grow Rich is a huge book. The current book I am reading, which was actually referred to me by a billionaire friend of mine out of Houston. I'm pulling it up right now on my Amazon. I am currently reading it. It is called Die with Giving All You Can with from Your Money Zero and Your Life. It's a very, very good book, also wrote by a billionaire, but it's a phenomenal book about working hard, racking up as many zeros, but also enjoying those zeros,
Yeah.
experiencing life along your way.
Love it. Love it. What, in the last 5 years, what new belief, behavior, or habit has most improved your life?
Mindset. my mindset, really meditating. So that's a habit now, is a meditation, and being able to, under highly stressful situations, be as calm as possible. I've had investors, I've had my team say, Chris, I don't understand how you are so calm under this stressful situation. So no matter what, I'm very, very calm. The world can be exploding, and I will find a positive solution out of that negative situation, but I will also stay very, very calm.
Love it. Love it. How can people reach out to you?
Please go to our website, qccapitalgroup.com. You can, once you get there, you'll see right at the very bottom and throughout our website, you can get a free copy of a book that I wrote. I will hand sign it. We will send it to you. It is no shipping. It is honestly a free copy that we send to all of our investing partners or future investors who just want to gain knowledge. So go to that website, qccapitalgroup.com. One of our team members will also reach out to you to see if you're a good fit for a partnership with us.
Love it. Thank you very much, Chris.
All right. Thanks so much.
Thanks for tuning in. If you got any value out of this at all, please like, comment, subscribe, follow. I'd love to hear from you. And for more real estate related content, market observations, upcoming events, you can go to investedx.com and subscribe to our weekly newsletter. I promise you won't regret it. Thanks again.